Consider you are a company. By one way or the other, you would have to bring in funds to run that company. Now, how do you bring in funds? There are two important ways. One is financing the debt or financing the equity. We call it as debt financing or debt equity financing, which we have covered in a separate lecture. In this section, we would cover 4 different ways under which public investors can fund. Those four are the initial public offer, which is commonly called as IPO. Now, for the first time, if a private company comes into public, they offer this IPO, and this is what is called as initial public offer. So, it occurs at a predetermined price. So, the company would announce a predetermined price at which it would open its IPO, and this is used directly to buy the stock of the company. The next is NFO, which is new fund offer. Now, first time a new fund scheme is opened for subscription, this NFO is offered. The interesting part about it is the base value is rupees 10. That makes it extremely attractive. Mutual funds also do extensive marketing before the sale of a new fund, and therefore NFO are again popular. As I said, they are issued at a price of rupees 10, and the money pooled from the investors would be put into the market. The next is OFS, offer for sale. Now here, whosoever are the promoters of the company, they would dilute their share, and they would dilute their share and provide it to whom? They would provide it to public. Now, when they are providing it to public, the shares would bid at an amount above a minimum floor price. What is floor price? We have already covered in our economics lectures. So, floor price is a price imposed or a limit on how much low a price can go. So, that would be the floor price, and this floor price is always higher than the equilibrium price. The only idea is to make it effective, and therefore OFS, which is the offer for sale, would be there for the shares with a minimum where they are bidding above a minimum floor price or a price floor, and they here the money would go to buy the stocks for the company. The next one is extremely important. These are NCDs, non-convertible debentures. Now, the idea is to raise fund for long-term capital. Here, the investments could be made in the public or in the secondary market, and the money that comes in would be used to raise the capital. Investors would get a fixed rate of interest against that. So, a fixed assured interest against that would be offered to the investors. So, there is where we understand 4 important components of financing. Extremely important, the difference between those, which is good one. Now, again, if I say OFS is one of the ways where there is a requirement where you require additional capital or you want to dilute the holdings in the public. Again, if a person is interested in a regular fixed income, they would go for NCD or a non-convertible debenture. Also, this non-convertible debenture usually gives a high rate of interest, and therefore it is again a preferred way. Clear? So, NCD, OFS, NFO and IPO. Now again, we have covered our detailed lecture on debt financing, equity financing, extremely important for this year's prelims. Don't miss a single point out of it. Very probable question for this time. We'll be covering many interesting topics in economics and an extensive study of micro and macro we have covered in the lectures at doorstep. The links are available below. Wish you good luck.